I am Annette Rose, and it's a real pleasure to be able to talk to you today about this really important topic. Um, like most of you, having lots of thoughts and lots of conversations about what is going on in the world and what it really means for, I guess, for my retirement. I am 53, but my husband is 55. So we are in that kind of last 10 years. For us, our aspiration was that we would certainly retire from full time corporate work at the age of 60. For me, that's kind of come a little bit earlier because I actually wrapped up from my corporate job in January this year, so 2026. And what I'm doing now is really working hard to create my own income streams. And actually, in a way, it's kind of pretty satisfying, although it's a little bit nerve wracking. So what we're really talking about today is how do you navigate your retirement investments in a changing world? How do we understand those global forces that are happening around us? And it seems like 2026 is uh, probably, for me, it feels like, other than the global financial crisis, and we're going to talk about some of these events in a minute, this actually feels like a period in time that has the most turmoil I have ever experienced in my financial life. Let's put it that way. All right, so before we get in, I do just want to say that nothing I talk about should be considered personal advice or, in fact, any kind of financial advice. I am not a financial advisor. I cannot possibly take into account anybody's personal situations when we're doing the kind of work that I do. What my aim is here is to educate and to empower you through that education to be able to make your own confident decisions. That is what it's all about for me. So please, if you do need financial advice, if you are getting close to retirement, please go and find a registered financial advisor in your country that can help you to make those really important decisions. All right, let's move on to our first slide. So what's going on in the world from a macro perspective? Macro just means what is the big picture, what is happening globally. So I know that a lot of the members who have joined this community are based in the US, and it doesn't matter where you are in the world, we are all being bombarded with press, media about what's happening in the US as Donald Trump is, I'm just going to say, he's putting his stamp on the world. Let's put it that way. So the first box here is about Trump and tariffs. They're probably the thing that we keep hearing about the most, certainly here in Australia. So US tariff policy has absolutely returned as a dominant market force. Import duties on goods from China and Europe and Canada seems to change every day depending on who is in popular favour with the president. In essence, what's happening here is it's rattling global supply chains. It's raising costs for business, and it has also sparked retaliatory measures. So, when we hear about, China's doing this, China's raising their tariffs, and China's not going to be sending products, the same has happened with Canada. There have been various things happening in other countries as well. What that's actually doing is it's creating waves of volatility across the stock market. So equities, bonds, and currencies. That's the first piece of macro context that I wanted to talk about. It's, as I said, it's probably the one that you hear about the most. Secondly, now this is it's a bit of a big one to wrap our heads around here, but it's a topic which is referred to as globalisation. And what is happening today is that we are seeing a phenomena which is called declining globalisation. So I'm trying to think of the best way to describe this, but if we think about, kind of really since the Industrial Revolution, early in the 1900s, we've seen an era where imports and exports, sending things to other countries has been increasing, and we've been able to have what's called frictionless global trade, where we can produce something in our country and we can easily get it to your country. And when we're not working in these high tariff environments, that is what we would call frictionless global trade. But we're actually seeing that unwind. We're seeing that come to a bit of an end, okay? So nations are reshoring manufacturing. They are more focused on their own country consuming the things that they produce rather than sending those things internationally. Now, what is happening here is that means that this structural shift is affecting multinational earnings for each of our countries. Emerging market growth and long-term inflation expectations are also changing. Okay, so it is important to know that this is happening because all of these things affect the stock market, which is where the majority of our retirement savings are sitting, certainly here in Australia, and certainly in the UK, and I know in the US as well. All right, let's talk about this third box, which is wars and shifting alliances. So we have conflicts in the Ukraine and the Middle East with what's happening in Israel and Palestine. We have intensifying US and China rivalry. All of these things are redrawing the geopolitical map. And of course, most recently, we have got what's happening in Iran. How is this impacting us? Well, here in Australia, and I know across the world, a really great example is that we are seeing a massive increase in the price of fuel. Think about how that pricing fuel is affecting the whole supply chain. I've just been out visiting very, very close family who are in the farming industry in Australia. And, we were having really good conversations about this because it kind of hadn't even really not occurred to me, but I hadn't really thought about, from a farmer's perspective. We have our friends who are kind of basically drilling a new bore to find a new water source on their farm. When that new water source is found, they have to run poly pipe, okay, so this is plastic pipe, from that bore to the tanks across the farm to actually get that water to where it's needed. What's happened to them this week is that price of pipe has increased by 30% because of the price of fuel. So when we talk about the costs on supply chains increasing, that is the kind of thing that we're talking about. That sometimes we're not even thinking about it. The price to get the meat of lamb to the markets has increased. That means that the profit of selling those sheep has radically been impacted. So this is where those types of things are actually being passed on to us as consumers. And what's happening then, so see in the bold text there on the slide, energy prices, commodity markets, so commodities are those things that we are using every day, and defense spending are all directly impacted. And that means that investors have to factor in heightened geopolitical risk premiums. So the key insight there at the bottom is that markets don't like uncertainty. And right now, there is a lot of it. Understanding why matters more than reacting to headlines. Okay, so hopefully that's given you just a little bit of a, kind of context as to what's actually happening globally and what those market forces are. All right, let's move on. Okay, so let's have a little chat about the stock market though, because one of the conversations I've had with people is people saying, well, I'm hearing people say that I should sell everything. I should get out of the stock market and I should be keeping everything in cash. Okay. I just want to say to you that this slide actually lays out that up until today, this is no guide obviously to what's going to happen in the future, but the market has survived every single crisis that has hit us in the past since its inception. Okay, so we have World War I, global war shut the markets. The New York Stock Exchange was closed for 4 months, and I'm going to show you a graph in a minute that shows you that recovery. 1929 to 1939, the Great Depression, markets crashed by 89%, and there was a decade-long economic collapse. 1939 to 1945, World War II, wartime uncertainty, but markets ultimately surged post-war. 1987, markets fell 22% in a single day on Black Monday. They did recover within 2 years. 2000 to 2002, now we're talking more our era, or my era certainly, was the dot-com crash. The tech bubble burst and the NASDAQ fell by 78%. 2001, we had the 9/11 events. Markets closed for a week. There was a sharp initial drop, but then they did recover. 2008, 2009, we had the global financial crisis. I personally was severely impacted by this because we emigrated from the UK to Australia in 2008. We kept our property in the UK and went into a massive negative equity situation. It was actually terrifying because honestly, nobody really saw the global financial crisis coming. And I was working in retail finance at the time. That was the worst crash since the Depression. The Standard & Poor 500 was down by 57%. However, it did recover fully by 2013. Now, I want you to really pay attention to these time frames of recovery because we're going to come back and think about this a little bit in a minute because it's related to the risk of the portfolio that you're invested in and how long you should be keeping those investments for, or certainly what the recommendations are. 2016, we had the Brexit vote. So this was the UK actually voting to leave the European Union. It was a shock result. UK markets were very, very volatile, but global markets did steady very quickly. COVID-19, 2020, very much something that has impacted all of us on this call. It was the fastest 30% drop to the market in history, and I remember it. But it was also the fastest recovery. There were new highs within months. 2025 to today, we have, of course, seen tariffs and we've seen wars. So we have ongoing trade tensions causing volatility, and that story is still unfolding today. The fact is, as we stand today, every single time the long-term investor who stayed the course came out ahead. Again, the past is no guide to the future when it comes to stock markets, and that's where you understanding what you can control is going to be super important. All right, let's move on and just have a quick look at the stock market performance. So as I was saying, what we can see here is that since its inception, the stock market since 1920 has risen from 100 points to 41,000 points. You can see it reflected here in this chart. The average annual return of Standard & Poor's 500, so the S&P 500, the historical average is greater than 10%, even taking into account all of those drops in the market. Okay, so every bear market has recovered 100% so far, and you can see where we are today. Even following COVID-19, how that stock market recovery has happened. All right, let's move on. So what is it that we can control? And I think this is the really important conversation that we need to have here. Now, as we come into this conversation, I am making an assumption here that you have got a bit of an understanding about investing. Now, if you do not have any understanding about investing, what I would really encourage you to do is get over to the classroom on school, because what you're going to find in there is that the Women's Money Success Path program that I have, that is actually designed to take you through in 3 distinct sections everything you need to know about money. The second part, which is understanding the economy, which is very much what we are talking about here, along with teaching you to budget and how to save. And the final part, which covers investing, retirement savings, and protection. So I would really encourage you to get over there if some of these concepts are making your head spin. All right. But assuming that you do have that understanding, and by the way, the call is recorded, you could jump away, do those courses, and come back and watch this call again. What can you control? Well, I can tell you what you can't control. What you can't control is global markets. Okay. You have no control over that. You can control your risk profile and your portfolio strategy. So your portfolio strategy is basically, what are you invested in? So let's talk about the different types of portfolios. Now, here in Australia, our superannuation system is completely set up for you to simply choose your portfolio. You can choose low risk, medium risk, high risk, and usually there is also an option for kind of what's called either green or sustainable portfolios. Okay, but we're not going to kind of get into that today. So low risk is where your portfolio will be invested in the types of assets which value stability over growth. Okay, so this is low risk portfolios. The type of person that this portfolio is suited to is somebody who is closer to retirement, somebody who needs their capital preserved. Now, your capital is the amount that you have invested. Okay, so that's your capital. And it's for people who have a lower tolerance for volatility. Now, we're going to talk about diversification in a minute, but in essence, you are the person who is in control of your risk profile. And your risk profile is always something that's really personal. You can't kind of be sitting there with a best friend or a family member and go, well, what's your risk profile? And they say, well, I have a really high risk profile. I'm not bothered about this stock market stuff. I'm not bothered about Donald Trump and his tariff wars. I am going to stay invested in really high risk as long as I can. That is a very, very personal situation. You can't just borrow your best friend's or even my risk profile. What you have to do is you have to work this out for yourself. You need to kind of really get in there and go, what kind of a risk profile do I have? And what I can do in the community, in fact, I'm going to make a note of this because it is something that I was going to do before, is to share with you a risk calculator. So you can actually go onto that risk calculator and you can work out for yourself what your risk profile is, okay? But the typical mix of assets in a low risk portfolio are cash and term deposits. These are what are called defensive investments, okay? Bonds and fixed income. And you can see there that there would be a very low portion of shares. Now, that low portion of shares is likely to keep you, kind of being able to protect your capital. But it's important to know that a very low risk portfolio may not outpace inflation. We're going to do a bit of an education on inflation in a second. All right, let's move over to medium risk. This is where we would be focused on balanced growth, but still with safety. Who does this suit? This would suit somebody who is kind of in mid-career. So this could be your 40s to your 50s. You have got some acceptance of volatility. So you've understood your risk profile and you know that in order to keep your capital protected and to keep growing, you do need to have some risk in there, okay? You probably have a 10 to 20 year horizon at this point. So, as I said, that's that 10 to 20 year horizon out from retirement. Now, your typical mix in this kind of a portfolio would be shares and equities, 40 to 60%. So you can see that's much higher than that low risk profile. Bonds and fixed income, 25 to 35%. And then property or alternative investments, 10 to 20%. This is going to be a smoother long-term growth. It will dip, in fact, as anything will do that is reliant on the stock market. but it should stay the course. Then coming over to high risk, you've no doubt heard the expression no risk, no reward, or high risk, high reward. Okay, this is where you have maximum growth potential. And who this suits is somebody that is in early career, you have a longer time horizon, and you would be comfortable with significant swings. Okay, typical mix here is shares and equities 80 to 100%. Global diversification, so you would be leveraging the global stock market, all of the different country stock markets, and you would be looking at growth stocks. Okay, so these are things that are much higher risk. Now, I actually have in my investment training over there on school, this is in part 3 of the Women's Money Success Path. I have this handy little picture to help you understand all of these terminologies that I'm talking about here today. Okay, definitely something that, again, if this is too much, it's too complex and you're not understanding it, you're definitely going to want to get over there and do that training. What that does have, though, is the highest long-term returns, but you can experience significant short-term drops. Okay, remember that chart that we looked at that had those ups and downs, ultimately over time going up. Again, your risk profile isn't fixed forever. It should evolve as your life, your goals, and your timeline change. It needs to be reviewed regularly. This is something that I talk about a lot. Our money isn't set and forget. It is something that we keep learning, we keep reviewing. And as your confidence grows, as you become more informed about money, it is something that actually starts to really light you up. You start to get more excited about it because you understand it. You start to feel more empowered and like you have more control. All right, let's dive into a little chat about inflation. So we hear about inflation all the time. The media seems to be obsessed with it. Why are they obsessed with inflation? Well, it's not just a number on the news. Inflation eats your savings and it eats your future every single day. All right. So inflation is the rate at which prices rise over time. What that means is that every dollar that you hold buys less than it did before. Australia's Reserve Bank, and in fact, most reserve banks in all countries target 2 to 3% per year. If inflation runs higher than 3%, what that means is that your purchasing power is shrinking faster. A great way to think about this is to think about your paycheck. So when I was working in a corporate job, for a long time, I was getting, this just seems incredible when you take into account what's happened since COVID, but for a long time, my paychecks, I would get pay increases, sometimes up to 6 or 7% per year. So you can see there that if inflation was 3%, my pay increase was 6%, that would mean that when you looked at inflation, so the amount it was costing me to buy goods and services, if that was at 3%, I still had another 3% growth, and therefore I was actually able to save and invest more money. Okay, so inflation 3%, pay increase 6%. That meant that 3% of my pay increase was going to purchasing goods and services, that increased price. The extra 3% was a real extra 3% where I could, kind of divert those extra funds, hopefully, if I was sensible, to savings and investments. I wasn't always sensible, but I've been very, very lucky that I have benefited from living in the UK and living in Australia, where superannuation and pensions were mandatory. So it didn't matter whether I was spending too much money or whether I was being financially irresponsible. A certain amount of my paycheck was actually being diverted to my retirement savings. Very, very lucky. So since COVID, though, what has actually happened is that I wasn't receiving pay increases. In fact, over the few years of COVID, so between 2020 and 2022, I did not get a pay increase, which meant my money was going less distance. Now, inflation was very low during the COVID period of time, because what happened was governments decided, or they knew that this was what was happening. And so they actually reduced interest rates, which meant interest rates for those people paying back personal loans, people who had home loans, your interest rates were very, very low, which meant those repayment numbers were actually down. Okay. Inflation, therefore, was also low. What was good about that was it meant that I was at home, I couldn't go anywhere. I wasn't spending as much money except for on groceries and probably on streaming TV. My repayment amounts on debt were low. And so that meant it felt like I actually had more money. I was feeling kind of richer. As we have come out of COVID, so we're now in 2026, and governments are really trying to stabilize inflation. Now, in Australia, we have struggled. So that inflation has been higher than 3%. Organizations, though, are not giving people pay rises anymore. Those pay rises are barely staying level with inflation. And so we're all really feeling it, especially when interest rates are going up and our debt repayments are going up as well. That is why you may be feeling like your money is going less far. Now, let's also look at what's happening to our spend. Groceries. I hear people talking all the time about it actually feels like I cannot fill my trolley anymore for the same amount, and I'm spending more and more money on groceries. I bet that's how you're feeling too. We already know that fuel and energy prices, especially because of the wars in the Middle East, are going up. And these are essentials that hit every household, not only because of what we're consuming, but because of what is happening to the supply chain. Rent and housing. So interest rates are going up. The price of mortgages, so the interest rates on home loans are going up. So what are landlords doing? Well, they're increasing prices. And you know what? We haven't even talked about capitalism and consumerism. So there is also a fair amount of greed happening right now. So people want to earn more and more money. And so landlords are increasing rents, which is impacting anybody who is renting. Healthcare. So medical costs typically rise faster than general inflation. So that may also be impacting you. So let's talk about the $100,000 reality check. So what is $100,000 in cash actually worth after inflation? So if today we had $100,000 and we didn't invest that $100,000, we just, I don't know, let's say that we had that whole $100,000 sitting in cash in our safe at home. In 10 years' time, that $10,000 would actually be worth $74,000 if it was a 3% average inflation. In 20 years, it would only be worth $55,000, because the amount of goods and services that $100,000 in cash could buy, you could only buy $55,000 worth. And in 30 years, that $100,000 would really only be worth $41,000. I really hope this is starting to make sense, because this is where we start to understand why understanding investing, understanding how to get returns on our money that outpace inflation is so important. So when we think about a 20-year retirement with 3% inflation, assuming it held at 3%, that would mean that your costs would double roughly. Therefore, your savings, your retirement lump sum, needs to keep pace. Cash that is sitting in a savings account that is earning 1 to 2% is actually going backwards in real terms. So I'm going to keep calling this out. If you don't understand these concepts, you really need to get over and do the Women's Money Success Path. As I said, part 2 covers the economy, budgeting, saving. And this is really, really important. So investments that grow above inflation, like shares and property, protect and grow your real wealth over time. And your retirement income target should be inflation adjusted. It should not be a fixed dollar figure. I know it's a lot to wrap your head around. It's a lot at 8 o'clock in the morning here in Australia. All right, let's jump on then. We are coming to the end of our conversation. So, what is it that you can control? We've already talked about the different portfolios. So your low risk, your medium risk, and your high risk. But the other thing that you can control is what's called diversification. What is diversification? Well, it's about spreading your money across different asset classes so that you can reduce your risk of a single asset class. I'm going to talk about this a little bit more, and smooth out the ride. In other words, don't put all your eggs in one basket. Okay, so what are all the different types of investments that we could hold so that we can diversify and spread our risk? Well, we've got cash and savings. So cash and savings are the ultimate defensive asset. Okay, they are not exposed to the stock market. They are fully liquid. What that means is if you have your money, all of it sitting in a transaction account, which is to all intents and purposes cash, the bank has to give that back to you as soon as you want it. So if you had $100,000 and you walked into a bank, they need to be able to give that back to you. Okay, fully liquid, no risk to capital. And here in Australia, it's actually government guaranteed. So even if the world was on fire, the government has a guarantee that the bank has to give you up to $250,000 back. That is incredible. But your returns will be below inflation because if all your money is either in cash in a safe in your house or it's in a transaction account, it's not earning any interest. So if it's not earning any interest and inflation is 3%, your money is losing value. All right. What should you have in cash and savings? Well, a good way to think about cash and savings is to make sure that we have emergency funds. So this is 3 to 6 months of expenses, maybe a little bit more if you are risk averse. Right. The second option in defensive investments is term deposits. So these term deposits have a guaranteed fixed return. They are low risk, and here in Australia, they are regulated by the Australian Prudential Regulatory Authority. Your money is locked in for a term, and the rate often beats cash savings, but usually not inflation long term. This is a great way to have your money earning for you, but also to still stay really defensive. So these are for short-term savings goals, 1 to 5 years. Very good in retirement or in those last couple of years heading towards retirement. What about gold? Everybody talks about gold, and I've got to be honest, this is something that I really struggle to wrap my head around. But gold and silver are both considered to be safe havens in crises. They hold value when currency falls, okay? It is not correlated at all to the stock market or to cash. It is simply an asset that holds its value. You don't get any income or dividends. The price can be volatile. So for example, if you looked at the price of gold over the last 3 months, you would see that even day to day, the price of gold can fluctuate depending on how people are feeling about the stock market. Okay. You may have storage costs if you go and buy a gold bar, a physical one. So if you were looking at it defensively, holding 5 to 10% of your portfolio in gold is great to hedge your bets. All right. Property is a tangible asset. You can generate rental income, or You could also generate income from something like an Airbnb income, which is something that I'm looking at the moment. I have a member in this community who has got a community which is called Retirement Replaced. That could be a really fantastic school community for you to go and have a look at. Okay, the thing with property though is that it is illiquid. What does that mean? That means if you needed the money, you would still be reliant on selling that property to get your money. There is a high entry cost. That kind of makes sense. You do have ongoing expenses, and property certainly isn't completely protected from market cycles. So, for example, in the global financial crisis, as I was talking about, a huge amount of people became what was called, they were in negative equity with their property. That meant the value of the property dropped below the amount that they had lent to purchase that property. That is not a fun place to be. I can tell you a lot about that, and maybe we'll talk about that when we do our property call, which was the second highest vote in what our live call should be. So perhaps next week we will jump into property. Property is generally considered to be a long-term investment. We have shares and ETFs, obviously highly volatile. You do need to have patience. You do need to have emotional discipline. As we have talked about, if you are somebody who has a low risk tolerance, shares and ETFs can be really, really scary for you. So definitely understanding how you feel about risk is something that's really, really important. And bonds and fixed income, they are certainly considered to be a defensive asset, so closer to cash savings and term deposits. They are still interest rate sensitive, and they are, still part of the stock market. So, yeah, those are all the different types of ways that you could potentially diversify. And then there are other things that could be worth money. So think about cars or classic cars. Think about wine. There are all sorts of things. Oh, jewelry. Jewelry is another one. So a little bit like gold. So there are all sorts of other types of alternative investments that you could choose to invest in. What is really important to think about is that the goal isn't to pick one winner. It's to build a portfolio that can weather any storm. All right. Gosh, that has been a lot of information, and I'm super glad I've had my coffee here today. If you are watching this live and you have, not live, sorry, if you are watching the replay and you have any questions at all, I just want you to remember there are no stupid questions, please. There is a category in the community which is called Ask Me Anything, or you could just put it in the general discussion. If you have a question, it is almost guaranteed that everybody else has that question too. So I really hope this has been helpful. Keep an eye out for the resource which I will definitely put in the community, which is where to find a risk calculator so that you can start to understand your own risk appetite. And please jump over into the classroom. Check out the courses over there. There are some good free things, and there are a few low-cost paid courses as well. All right. I hope you have a fantastic day, and I will see you real soon.